Hello everyone, welcome to our explanation of chapter 4. Before we get to our PowerPoint slides and talking about uh, those things that are subtracted to get AGI. So these are what we referred to earlier as 4 AGI or above the line deductions. There's a very limited number of them. They are all on Schedule 1, Part 2, as you see on your screen. And we're not going to necessarily do them in the order that they're presented here. And there are some that we're going to leave out that have to do with retirement plans. And there's some that come up so little that we're not going to spend time on them, mostly the 24 and below. But the others we're going to look at. Because they're on this form. These are all subtracted for AGI. And we will cover them in the order that they're covered in the textbook versus how they're listed here. But they're all on here that we're going to talk about. So jumping into our PowerPoint slides, we're going to talk about the first of our 4 AGI deductions, and the one that probably is most common and probably the one that you most likely are going to deal with personally, and that is qualified student loan interest. Some restrictions having to do with this. First of all, it has to be a qualified education loan, pay for the education expenses, taxpayer, taxpayer spouse, or any dependent. Again, key to know who the dependents are, because you know if this works for only dependents, not for others that we took loans for. First limitation, I guess after you qualify, if you have the right kind of loan, is that it's only $2,500. Regardless of how much you pay, the maximum your deduction can be is $2,500 in a year. So, a little more about qualified loans. Notice that it is, there's some limitations on what the costs include. And you have to be careful with any time you're talking about qualified education expenses. The definition of what that means for different deductions and different issues can be different. But in this case, it's a little bit broader. Tuition fees, books, supplies, even room and board, transportation, and other costs of that. If you took out a loan in order to cover that, okay, that is a qualified loan. And it has to be at an eligible educational institution. Okay, it has to be somewhat related to the loan, and it has to be done while you're going at least half of a full-time workload. Okay, so basically the same criteria as for financial aid. It doesn't matter whether it's undergraduate or graduate level, so they haven't differentiated between the level of education like some other education benefits. And then it is also phased out if you're AGI or modified AGI, which is, as it says there, just a couple of things that are taken out of AGI first. No, we haven't covered yet. The only thing that's really really, it's the deduction for student loan interest, right? Is the only thing. So you have to look at your deduction, your AGI, before you subtract out the student loan interest to see where you fit on the threshold. And here are the amounts for which where the phase out starts to happen. $165,000 on a joint return, $80,000 for a single return. So that single return would include anybody that is single. Not notice what's not here. Married filing separately, you don't get anything. It starts to phase out at 0. Okay, but and it's totally eliminated by the time your income gets up to $195,000. So it's a $30,000 window for a joint return and a $15,000 window for single returns. So literally, if your income is $96,000 on a single filer, you don't get any deduction for the student loan interest, regardless of how much you paid or any of the other issues that have to do with it. So how do you calculate how much you actually get or is disallowed? Okay, the one way to look at it is just take your modified AGI over the threshold. So if it's under $165,000, you don't have to worry about it if you're filing jointly. But if it's over $165,000 but under $195,000, then you take the amount that you are, subtract the $165,000 divided by $30,000, and that's how much you can't use. So the rest you can. And the single payers that uses $15,000, same formula. And if you'd like to use a worksheet, okay, they do provide one in the instructions for this particular line item, as they do for many things, but this one specifically, it helps you go through the process of applying those thresholds. So check ourselves, see if we remember. Okay, you have to be able to roll at least half time during the time you incur the expenses. Okay, it does include tuition and fees. Okay, but many other things, but at least those. All right, and it starts to phase out at $165,000. Don't forget that. Much lower for single filers. The second one that we're going to look at that is a 4 AGI deduction is the cost of or the amount to put in, contributed to, however you want to think about it, to a health savings account. This is a savings account used for only qualified medical expenses. Okay, you have to set it up especially for it. It can't just be a regular savings account. It has to be set up specifically with a provider that's what it's for. You can do that if you qualify when you put money into this plan, but you are only eligible if you are self-employed or employee of an employer that has a high deductible plan or no health coverage at all when you purchase. So you have to have no other basic coverage except for a high deductible plan, either through your employer or yourself. Now, high deductible plans mean that deductibles have to be a specified amount, and that's the next slide. Okay, so you can't have other insurance. This can't be a second plan or anything like that. But there has to be a actual high deductible insurance plan in place. If you don't have that plan in place, either through your employer, you cannot have a health savings account, and therefore no deduction for money putting into a health savings account. You can set up a savings account and save money to pay for your medical bills, but it wouldn't qualify for the benefit we're getting here, the deduction for AGI. Okay. You can have other types of coverage, like dental coverage and long-term care coverage, but you can't have other health insurance coverage. Okay, that needs to be your only plan. So how does it qualify as a high deductible health plan? You see that it has to have a minimum deductible, can have more than that, but minimum of $1,600 or $3,200 for a family. But the maximum, okay, for out-of-pocket expenses in a year for the plan needs to be $8,000 or $16,100. That is also the maximum you can put into the plan as deductible. So you can put up to, you have individual coverage. You've got your high deductible plan in place with a minimum deductible of $1,600, and you can put into that plan $8,050 total. Now, if you have it through your employer, a high deductible plan, okay, and they put money into your HSA, then the amount you could put more into it, as long as the total between what you put in and your employer puts into your savings account is only $8,000 if you're individual, or $16,100 if you're married family or have family coverage. So that's the situation. So at Hack, we have a high deductible plan. Okay, the Hack puts money in, I put money in. Okay, into the savings account. My maximum putting it in, because I have family coverage, 16,100. I never come close to that, but we do put money into it, and that's what would be maximum deductible. So if you put money into or take money out of an HSA, there is a special form. Of course, IRS is great at having lots of forms for every possible situation, and that's the form here is not too hard to remember because it's 8889. But I don't expect you to remember what the forms are. That's something you'd look up anyway. Okay, so the amount we're talking about, assuming you don't go over the maximum, you have everything in place to qualify, is a 4AGI deduction. Okay, on the 1040 Schedule 1 that we looked at the beginning. And down the road, maybe it's a couple months, maybe it's a couple years, where you use money from the HSA to pay medical bills, that is not included in income as long as they're used to pay for qualified medical expenses. Okay, you have to set up the account with an insurance company or bank, with a trustee or custodian. Like, it can't just be your regular savings account. Okay, there has to be a trustee involved who's keeping track of what you put in, what you take out, that sort of thing. All right, the next one, moving expenses. This used to be available for everybody. Now, notice it is only for members of the armed forces. Okay, and their spouses and dependents. And even that only on active duty, right? Okay, so very limited. Active duty moves because of a permanent change of station. They can deduct the following: move from one place to another, from one permanent post to another, okay, or something nearer to the United States. All right. So the service member would not include or take a deduction for AGI value of moving and storage services. Okay, temporary lodging expense, lodging allowance, okay, that sort of thing. But what if their reimbursements are not as much as they actually spent? Then they can deduct that as a 4AGI deduction, or if they get more than they actually spent, or the allowance is, okay, then that is actually wages to them. Okay. So some things that you might consider for moving: storage of household goods as you get them across the country. If you drive your car, 21 cents per mile for driving from the place you move from to. Okay, and that could include multiple cars that you have to take because you have more as a family. You have two members of the military and a spouse. They could each buy a car, and it could be 21 cents a mile. That would be in addition to any cost for the actual moving truck. Okay. It's almost always better to just use the mileage, 21 cents a mile, than it is to count up all your receipts for gas and oil and all that type of things. Airfare if you fly, parking fees and tolls along the way, but no meals, no side trips, and not overindulgent on hotels along the way. Okay. A little bit different on foreign countries, but not something we're going to worry too much about. All right, the next one deduction is for half of the net earning of the self-employment tax that they pay, sometimes referred to as FICA tax. And that is for people who are self-employed, and they pay 15.3% of their net earnings from self-employment. Now, this is to make up for the fact if you're an employee, you have FICA tax taken out of your check, and your employer pays the other half. So you're also putting in 15.3% of your earnings into the FICA program, if you will, but you only see it taken out of your check as half of that. The other half is just paid, and you don't actually even think about it. But if you're self-employed, you have no employer. So you have to do both. You have to pay both halves, which is why it's 15% instead of 7.65%, which is what you would see on your regular paycheck. So you're self-employed, you calculate your revenues, you subtract out business expenses, then you multiply it by 0.9235 or 92.35%, however you want to think about it. And that number is then multiplied by 15.3%. This is all calculated on Form SE, okay, which is filed with your 1040. We won't get into the differences, but FICA includes both Social Security and Medicare. For here, when we get to self-employment in more detail in Chapter 6, we'll break that down a little bit more into how much is Social Security and how much is Medicare. But for now, this is as much as we need to know, because what we're worried about, okay, is we get a deduction for half of that self-employment tax. Okay, it is a above the line or for AGI deduction, half or 7.65%. As you will, after you multiply by 0.9235, as it says on the last side. Okay, so yes, you ought to pay more taxes, but you at least get to deduct part of them off your AGI. All right, another one for self-employed folks. Self-employed folks usually have a hard time getting health insurance. They obviously don't have a group of people to share the costs, and so we decided that they should get a deduction for paying for their health insurance. Because most people who work for an employer, their employer pays for their health insurance and they don't have to report it as income. So this kind of puts them on the same thing by deducting 100% of the self-employed health insurance payments. But always, as usual, there are limitations. Okay? Cannot take a deduction for the amount of the excess of net earnings from self-employment from the trade or business which the coverage is provided. What does that mean? Well, if your business has revenues of $10,000, expenses of $5,000, so there's earnings from that business of $5,000, the most that you could have in health insurance deduction would be $5,000. You cannot have more in the health insurance deduction than you had in income from the business which provided the health insurance coverage. Okay? The other thing is you can't have health insurance elsewhere. Meaning if you are both self-employed and an employee, if you have opportunity, even if you turn it down, if you have an opportunity for subsidized coverage, meaning that the employer is going to pay at least part of it from your employer, you can't take the self-employed health insurance tax deduction. So it needs to be your only choice is what you're paying for your self-employment health insurance. If that's your only choice, then you can deduct it. But for AGI, but not if you have access to it through you or your spouse even. Okay, then this deduction is not allowed. Okay, this is a pretty minor one. Penalty on early withdrawal of savings, been in the law for a long time, and everybody nobody remembers exactly why we put this little thing in there, but it is. Okay, if you pull money early out of a CD. So if you go to a bank, you buy a CD, you are agreeing to keep your money in for a specified amount of time, 1 year, 2 years, 5 years, whatever. If you pull it out early because you need the money, they're going to charge a penalty. Okay? What it really does is come away out of the interest that you would have gotten on the CD. Okay? That is going to be reported to you on the 1099 INT, right? Interest. And so really just is going to be on the same form, and it's just going to reduce your income for AGI because you got charged it, and it comes out of the interest that you would have made. All right. More important and becoming less important every year is alimony paid, because in 2017 the laws changed and said that alimony is no longer count, if you will, if you have an agreement of divorce after 2018, the end of 2018. Okay, so if you're divorced and had an agreement prior to 2018, okay, and you haven't made substantial changes to it, you can still deduct. There's still a deduction involved, and the idea is, okay. So, but if it gets majorly changed, or you didn't enter into an agreement until after 2018, then it's not deductible, not included in income, but for anybody, and it's not deductible for anybody. It's not considered for tax purposes. So, in some ways, that makes everybody's life easier, but for those agreements, but on the other hand, it's an important tax issue that could still exist because a lot of agreements are going to go on for many years. So, how does it qualify as alimony? Well, we're pretty specific in the tax law about what it matters, what counts. First of all, it has to be in cash. Okay, no payments in kind, no giving of property to the other spouse. Okay, so we're talking about required under the divorce decree. So there's a written agreement that says you got to pay this amount of money every month or every year or whatever it says. It has to be in cash, and it has to end with the payee spouse's death. So the payer is the one giving the money. Okay, payee spouse is the one receiving the money. If they die, you stop payment. So any payment that's going to continue. So a payment on a mortgage that you're ordered to pay, and that mortgage has several years on it, and obviously it will continue, and you have to continue to pay it, even if your spouse who is living in the house passes away, then it is not alimony. Okay, it has to end with the receiving spouse's death. Okay, so a couple of things that people try to get away with. They try to, because other payments in a divorce are not taxable. are not included deductible. So, for instance, child support is not deductible. Property settlements, which is dividing up the property at divorce, any amounts divided up are not deductible. So sometimes a spouse might want to deduct it, so they change their property settlements into alimony, which means they have a lot of alimony right after the divorce, and then it drops off. If that's the case, you could have situations where they reclassify what you called as alimony as a property settlement. Kind of you might say a look back period, 3 years to go back. You get 3 years down the road past the divorce, and you look back and see if that was the case, and you might have to change how you did it. That is, of course, not much of an issue now, because now every divorce situation that we're dealing with has to be at least 3 years old, right? Because it's after 2018, before 2018, right? So this is pretty much not that important anymore, okay? What continues to be important is child support issues, okay? Because if you've got an ongoing payment, and some of it is child support and some of it is alimony, okay, we have to differentiate, because the child support doesn't count for tax purposes, and the alimony does if it started back before 2018. And the tax law says it doesn't matter what you call it. What matters is what it looks like. So, for instance, if a payment amount is going to be reduced when a child reaches 18, then it is child support, even if you called it alimony or separate maintenance agreement or anything else. It is still alimony. It's still child support if it gets reduced. And if you don't pay all that you are required to pay, the amount first goes to child support and then to alimony, only if you've covered all your child support. Okay? So, all that said, if it qualifies as alimony, it is a 4 AGI deduction for the one that pays it, and it's included in AGI for the one receiving it. Now, educator expenses. The tax law decided that teachers were spending too much of their own money trying to buy supplies for their classrooms and stuff like that, and we're not getting reimbursed or anything like that, so we needed to give them a tax break for that. So, eligible educators, we have to $300. Whoop-de-doo, okay, of qualified education expenses, a 4 AGI deduction. So that means whether they itemize or not, whatever other deductions they have, they can still benefit from this. If they're merely filing jointly and both of them are teachers, then it can be $600 maximum. But you both got to have their own expenses. It can't be that one spouse spent $600, the other one didn't, but just because they both are teachers, you get to take $600. They have to use their deduction for their expenses. So what is an eligible educator? Teacher, instructor, counselor, K through 12. So I am not a educator, do not qualify for this because I'm not teaching kindergarten through 12th grade, and it can't be too much part-time, right? At least 900 hours. Now that's still somewhat part-time, and can be measured on the academic year, but it's still not a full-time. Yeah, it's got to be pretty close to getting close to a full-time educator. And things that qualify as these types of expenses, and of course you'd have to keep some evidence of what you spent on books, supplies, equipment, other materials. Then they expanded it to PP&E, things that you dealt with the pandemic, because they were convinced so that in case schools were not providing enough of this through their teachers.